By and large, I do not think it's a material development. I was part of the S&P sovereign ratings team when the U.S. got downgraded famously in 2011. Richard was a former colleague. But I think markets have basically dismissed it, and probably correctly. The ratings are basically a slow-moving signal. I think it does not take a grand sovereign and analytics genius to understand that the fiscal profile of the U.S. is much worse than it has been. Yeah. The governance in charge of public debt is much worse than it has been, and it's frankly probably not comparable to any of the other AAAs out there.
Yeah, you're absolutely right on that front. I think the markets also, it seems like from the U.S. futures, will move beyond this issue soon enough. But when it comes to the overall fiscal situation with the U.S. economy, they're talking about a budget deficit of, 6.3, 6.5%. And that's significant, right? Something has to be done about it. The U.S. can't be continuing to be in spending mode for the while that it has been. So they've come out with pandemic stimulus, tax cuts, investment programs for infrastructure and clean energy. At some point in time, there has to be some sort of balance and give back.
What I think is interesting about what you just mentioned really relates to market conditions today. Why is the deficit growing if we supposedly have such a robust economy? And that's really what I think some people should be asking. The reality is we've had this huge stealth fiscal impulse over the past half a year because revenues have failed to come in. Now, why are revenues failing to come in? Clearly, the strength of the economy is probably not as robust as it may seem from recent macro data. It looks very good, but that's kind of in the rearview mirror. You look ahead and a lot of cracks are showing. It's the classic long and variable lags, but they really are happening.
But Jules was making this point earlier. It's about benchmarking in the markets, right? And so if the data doesn't look as bad as expected, then that's a good thing. I mean, you're talking about recession risks at the start of the year. Now you're talking about soft landing being the primary scenario. Now people are saying it could be pretty bright, the outlook on growth.
Well, all I got to say is read history. Historically, it looks very bright right before the economic contraction. It's not like you have a gradual glide path and you go from strength to moderate strength to a kind of a descent into contraction. No, it's robust until it's no longer robust, and that's basically what's going to happen here. I think the soft landing story is quite a mythical fairy tale that we want to believe in, but it's probably not true.
Well, I know a lot of bearish investors who are probably watching this show. It's going to be music to their ears, your view. But I think the question is for those investors who are short the market or who do take your view that a soft landing just seems impossible at this stage, have been burned many times so far this year because the market, if you're right, it's been complacent about these risks. So what's going to ultimately be the catalyst to drive markets lower?
I think the immediate catalyst is what you just had up on the screen, which is there's a big shift clearly in the Treasury market. What is happening now is you have mass issuance of Treasuries, particularly long duration government debt. That's in parallel to the quantitative tightening runoff of the Fed balance sheet. So that squeeze is lifting long-term rates. And that dynamic is going to start to have a squeeze also on risk assets. As long-term rates go up quite a bit, that is basically a challenge, throwing down the gauntlet to equities, saying, is pricing correct or not?
Yeah. Well, looking at Europe, you could argue that the economic picture is more dire than in the U.S. And you look at industrial data that we've had out of the Eurozone over the last several weeks, and it paints a fairly downbeat picture. And yet, again, European equity markets have been fairly resilient. Why in particular has Europe held up so well when not only is the data deteriorating, but the ECB seems resolute in its belief that more rate hikes are needed?
I think the European data, the uncertainty over the downside is not as great. Yes, we have stagnation in Europe. It's not pretty. You're basically in a zero growth environment for a few quarters to come. But that's basically in the price. In the US, the story is you could have the soft landing fairy tale, or you could actually have quite a normal average, maybe an outsized above average recession. The uncertainty goes both ways. In Europe, it does not really. And therefore, the pricing, I think, to some degree reflects the fact that, yes, it's zero growth. Earnings should not be rising very much up here, but the pricing reflects where we are.
Given that you had macro policy, would you say that the appetite that we would see for shorter duration bonds from here on would perhaps only increase, given that the curve has started steepening or sort of balancing itself out, the 210 spread?
Yeah, it's interesting because typically the steepening of the curve should be a good sign.
Yeah.
But historically, what has happened is you get the inversion, and then at the peak of the inversion, you get kind of a retrenchment, which is what we're seeing right now. The retrenchment is typically right around the time when the economy starts to falter. And you basically get the benefits of the steepening come a few quarters delay when you actually hit the bottom. So the timing is a little bit counterintuitive here. So what may seem like a positive signal from the markets is actually not.
Can I just come back to the Fitch downgrade, simply because it's great to have somebody with us who is a member of the team at S&P who initiated that sovereign rating downgrade back in 2011, because so much of the commentary of the last 24 hours has been, this isn't as big of a shock because of that 2011 downgrade. In your view, is there a chance they see their rating restored?
No. That's the short answer, unless you imagine that U.S. politics takes a turn for a much more stable, predictable path.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.